All right, welcome to this quarter's 20 minutes on the market. My name is Josh Whalen, an advisor here at Alterra Advisors, joined by Grant Monson. Grant, thanks for joining.
Hey, thanks. Glad to be here.
Yep. So we have a lot to cover in our discussion today. So we're going to get started right in. We are going to start with some of the big questions. Kind of what do we plan to cover today? We're going to deviate a little bit from some of the things, if you've watched this, that you're used to seeing right at the start, and talk about what's happened in the last week in the market and a history of volatility there. And then we'll go through some updates on inflation, interest rates, and then touch on what happens in election years in the market, a question that we're getting quite a bit. Okay, so starting out with what's kind of been happening in the last week of the market. We've talked about this thematically quite a bit. The stock market has been expecting that as inflation continues to improve, that the Federal Reserve is likely to start cutting rates. That's good for growth. And on Friday, what we saw was some weaker than expected jobs data. Okay, so it's not a problem if we see that at about the time when the Federal Reserve is expected to start cutting rates. However, a lot of folks are saying, and Grant, you can chime in if you've heard anything different, but it seems like a lot of folks are saying we should expect a rate cut or two in the fall, but not this early. And so if we're starting to see slowing growth earlier than the Federal Reserve starting to cut rates, that's a surprise to the stock market. We know the stock market does not like surprises. And so that's caused an increase in volatility. What has that actually looked like? Let's actually toggle over it and take a look. So this is the last 5 days in a few different market indexes here. Google Finance has some great analytical tools, but what we can see is that right at the top here, the S&P 500 common benchmark for the U.S. stock market is down about 5.25% over the last 5 days. Another thing we've talked about, if you've watched this in the past, is that the largest companies in the S&P 500 carry more weight. So even though that benchmark tracks 500 companies, the top biggest seven tech companies, sometimes you'll hear those called the tech titans, are about 30% of that weight. The next line down that you see is, what if all of the companies in the S&P 500 were equally weighted? That benchmark's only down about just under 4%. So still a pretty decent decline. You can see dividend-oriented stocks are not down as much. International stocks aren't down as much. And then bonds actually have seen a little bit of an increase over that time period in terms of pricing. So what does that tell us? The stocks that have rallied the most, those largest tech companies, are also the ones that we're going to see the biggest downward volatility with when uncertainty strikes. They're the ones most affected by higher interest rates because it increases their cost of borrowing and so on. So the story makes sense of why would we see increased volatility, at least on a short-term basis. And then in the last couple of days, we've seen a decent amount of recovery. Grant, anything to add there before we jump into a little bit of a history of stock market volatility?
Not really. I think it's important to remember, I think as we're going to talk here a little bit is we haven't felt this volatility for a while. So I think it shocked a lot of people.
Yeah.
But if we zoom out and look at the history, volatility and like this is par for the course within a calendar year in the markets often.
Well, you're leading right to the next kind of resource that we wanted to point out on this. This is a resource we've pointed to in the past by Capital Group. What past stock market declines can teach us. We'll link to this in the notes if you'd like to dive deeper. They have some helpful lessons to learn and so on. But one of the things that we really like here is it talks about a history of declines, severity, and frequency. So you can see here you have intra-year declines. How often does the market drop 5% or more, 10% or more, 15% or more, and 20% or more? And this surveys between 1953 and then the end of the year in 2022. So what this tells us, what we just saw was a market decline on the order of 5%. This tells us on average, that happens about 3 times a year. 10% or more might happen once a year. 15 or more 3 times once every 3 years, and 20% or more once every 6 years. So without belaboring the point, what this tells us is volatility should be expected and not a surprise. So with that in mind, let's jump over to a few of the kind of bigger themes that we saw play out through the first quarter of the year. And Grant, maybe you can get us started with a look at last quarter's economic activity and updates there.
Yeah, absolutely. And for those of you that keep in tune with us on this quarter to quarter, you will recognize this slide. It's our speedometers here that get produced by City National Rockdale to give you an idea on one dashboard of where things are headed in the economy. So these are typically forward-looking 6 to 9 months. And since last quarter, you'll see we haven't had a lot of shifts in those indicators of any major amount. International outlook has improved a little bit, so we might see some improvements there of international markets catching up with US a little bit. We're not expecting that anytime in a major way soon. Valuation down towards the bottom right there is still in the red. A lot of this is largely driven by the big rally that we've seen in the tech market, especially that's really driven up the valuations, which we'll talk a little bit more about later. Inflation is positive because it is improving and it has continued to improve. It hasn't quite gotten to where the Fed wants it yet to start driving down those rates, which a lot of people are really anticipating. We're thinking maybe 1 to 2 rate cuts this year. And then the other big kind of theme here is housing has slowed, both existing home sales and new home starts. So we wouldn't be surprised to see some negative feedback coming in that sector as well. But this really is all driven and kind of all involves what's going on in monetary policy, which you can see at the top left. And that really is code for when is the Fed going to cut the rates? So let's move on to the next slide here, because that's going to really indicate, that's really going to drive a lot of future changes in the economy. So a couple things I want to point out here on the top there, the real annual GDP growth. We've seen positive growth in the rearview mirror. 2023 had come in reported at 2.5%. That's great. That's forward movement in the economy. That was back when we were still expecting potentially to see some recession. So we've kind of hit that bottom and we're seeing some positive growth, albeit slow. 2024 is expected to be positive as well. The other key thing on here to point out is headline CPI. You'll see it circled there in the middle. It is slowing. That's our inflation, consumer price index, slowing in the 2.75 to 3.25 range is expected. Not quite to the 2% target that we're looking for, but it's headed in that right direction. So where we go from here is really going to depend on the Fed and how fast the rates are going to be cut.
So we can take a quick look at some kind of helpful updated information. This slide, there's a bit going on here, but what it does is it introduces what might be a new concept for some folks. So CPI, Consumer Price Index, is the most commonly reported in the news benchmark of inflation. But believe it or not, it's actually not the key one that the Federal Reserve looks at to indicate when they should start cutting rates or make decisions. What they more commonly look at is Personal Consumption Expenditures Index, or PCE. Why would the CPI get more reported than PCE if the Fed cares more about PCE? CPI is available much faster. It comes out about 2 weeks ahead of kind of the refined data that you see in this benchmark. What's really the difference? Why would there be multiple benchmarks here? Really the key difference you can see over on the right side here. This looks at the weighting of different types of goods across the economy, goods and services. Okay, so in the dark blue, you see how the consumer price index weights each of these basket of goods. They add them all up, they average them out, and that's your inflation rate. How much more expensive did we see these things get over varying time periods? Uh, the core difference that you'll notice is how the CPI versus the PCE rates housing and a few other small things. So let's direct our attention back to the left here. We're heading this yellow line is really that 2% target that the Federal Reserve wants to see. But what you're seeing is that the consumer price index is a bit ahead, still higher, persistently higher than the personal consumption expenditures index. And that's really because housing has been one of the stickiest areas of inflation. It's been the most stubborn to come down. We haven't seen mortgage rates come down yet. Rents are still high, things like that. So, though we're seeing that maybe a little more persistently high, you can see both are trending in the right direction. And then you can see this PCE line, this lighter blue line, headed more directly toward that 2% target. Grant, like you mentioned, they seem to be headed in the right direction. That housing area is a little sticky. You've heard the Federal Reserve specifically make comments about that being a concern. But again, this is evidence that things seem to be headed in the right direction. And couple that with, Grant, what you mentioned just a moment ago about how growth is actually looking fairly positive. And then one kind of note, remember when we talk about inflation coming down, what we don't mean is prices coming down. You're not going to go to the grocery store and see things cheaper. What it means is the rate of increase has
Mhm.
slowed. What the Federal Reserve wants to see is something like 2% increases every single year, not actual prices coming down. That's really the key indicators that they're looking at. So with positive kind of information like that, even with some of the jitters that we've seen in the last week, let's take a look at what this might mean or what this meant for the stock market through the first two quarters, and what might be coming down the road here.
Yeah, so you look on the top there, the S&P 500, which is tracks the largest 500 US companies. You'll see the trailing 1 year is 22.7%. That's pretty nice. Again, a lot of that's been driven by the weighting into the tech stocks like Apple, Amazon, Nvidia. And then when you look down below at the Dow Jones High Dividend Index, you'll see 1 year is about half, 11.5%, 11.44. Think of this like the Bank of America's, the Johnson and Johnsons that pay their profits via dividend. They will perform better when we see a drop in rates. So a lot of opportunity there that we'll talk about later. International stocks measured by the MCSI EFA, they're 1 year about 11.5% too. The international markets are not performing as well. They haven't had as much growth as the US markets. And on bonds, you'll see the 1 year 2.63, the 3 years -3. That's a shock because of that dramatic increase in interest rates we saw in 2022 really made the bond market unstable. But what does this really all practically mean for you? Let's take a look at some blended indexes because really what it means to you is what's the role of your portfolio for your unique situation. Let's take a look at this for a second. So aggressive growth at the top, we put together a 75% US market portfolio, 25% international index. So the 1 year on that's 19. Compared to maybe a growth investor that has maybe 20% bonds in that nice blended portfolio, has a balance between growth and dividend stocks, very common. Their 1 year is 14%. So you'll see that kind of blend out, and the 3 year numbers blending out a little bit different. And then we have a lot of people that are sitting here like, I'm feeling a little bit behind almost maybe because I'm trying to generate income. I'm in retirement. I have this high dividend portfolio with a little bit of growth because I don't want to take the risk of that. I got 40% in bonds. They've only gotten about 10% the last year, and over 3 years, maybe 0 to 2.5% you can see in that index. So it just depends on what the role is in that market. And it's important to look and make sure you're tracking the right index for whatever's going on in your unique situation and portfolio. But let's jump into
You'll
the.
let just
Oh, go ahead.
real quick, you'll hear us talk about this as your portfolio story, knowing what should be happening in the portfolio you have. Why do I have it? And then what should my portfolio be doing given what's happening in all of these categories? If you're a client of ours, that won't be news to you. You'll have heard us talk about this as kind of a way that we tell is what's happening in your portfolio. Does it make sense given what's happening in the market? So sorry to cut you off there, Grant.
No, that's a good point. Taking a look at the weighting of the U.S. market, looking into the S&P 500, we've talked about this before. Direct your eyes to the top green bubble. You'll see that 39% of the S&P 500 is weighted across communication services and information technology. So we talked about it earlier. The top 7 companies in the S&P 500 are tech companies, and they make up about 30% of that whole market. And you'll see they're driving most of the return. So that's when you look at all the other sectors there in the bottom left, they've been driving more normal returns across the general market there. So there's a lot of a weighting imbalance here. Now, when we're thinking about it for accumulators, where we have a lot of this volatility we've seen lately, it isn't really a problem, though some people might be really overexposed to a tech company. That's going to feel great right now. But as you saw at the beginning of this overview, the area that went down the most was the S&P 500 last week, and that's because of this weighting. Because where those are really frothy valuations, they're going to be the most sensitive to any kind of negative news. If you're in a retiree camp and you're looking for stable income, your strategy is going to look a lot different than growth stocks that are overweight in the S&P 500. Probably going to see more of those stable dividend type companies. So it really depends on tracking what you need to track depending on what your goals are. Let's move on to the next page here. I want to unpack one other thing here. Um, the price earnings ratio is one measure of measuring value in the general index. So how much dollar a price I'm going to pay for $1 of earnings of a company. So we look over at the bottom here, you'll see this price earnings ratio showing that S&P 500 is overvalued based on the price people are paying for a dollar earnings. But that doesn't tell the whole story. If you look up at the top right, you'll see that 34.9 forward price earnings ratio. That's the tech titans, those seven that I just identified. If we take them out, we have an 18. If you look at that, if we equal weight the index, we have a 15, which puts it more down in that fairly priced range. So we don't have a huge overvaluation across the market. We have an overvaluation in the tech sector of the market, which is a big difference to keep in mind here as you watch how the market behaves. Moving on to the next page, I want to show you another part of the market, dividends. So when we take a look at dividends, same chart on the left there, price earnings ratios of these various companies that are in that dividend index. You'll see it's more in their attractive range. They're going to benefit from drops in rates. So you want to see a sector that's going to potentially have some upside potential, more attractively valued, and have more upside when rates come down. That's going to be more on the dividend side. On the right side, you can see that 7% number. That's been the average growth rate of dividends over time. So we've seen a lot of positivity here, even though we haven't seen the big upswing in dividend companies here. And in the recent couple of years, they do provide a lot of value for people trading income and trying to beat inflation over time.
And think about that 7% growth rate. That's inflation protection on your income. It's not guaranteed,
Absolutely.
obviously, but that's a good way to look at how do I know my income's going to keep up with inflation? Well, if you have a portfolio like this that's focused on higher dividend paying companies and those have a historical track record of increasing their dividends, you've got some reason to believe you have some inflation protection there. Um,
Correct.
on the bond side of things, you're also seeing some attractive yields, meaning what for the bond that I own, what income am I taking off this? For high yield, you're in this close to 8%. Again, this is as of the end of the last quarter. On investment grade corporate bonds, 5.3. You're also seeing similarly competitive rates for municipal bonds. So if you're a high tax paying investor right now, your tax adjusted return on something like a municipal bond, which kicks out tax-free income for most folks, would be potentially even higher than what you're seeing here. So this is all about understanding what you need, where you're at, where you're headed, and the right type of investments for your particular situation. So lots of positive things happening out there. Moving to one last question. Okay. So what does the market do with elections? This is, if you're asking yourself this question, you're not alone. This is a very common question that we get. I'm going to leave this up here and you can pause and really digest this. But what we see is that on average, the second highest performing year tends in the stock market, S&P 500 tends to be that election year. It doesn't mean that that's always going to be the case. But in an election year, 18 years positive, 5 negative. So again, that's not to say that's guaranteed what's going to happen this time around, but there's good reason to think that you should not be changing your investment strategies based on what's happening in the market. So let's wrap this thing up. A few themes to remember. Some of these are going to look familiar. We've talked about understanding what portfolio you should have relative to your goals. You should be making that decision first. Your portfolio story is how should my portfolio be performing based on what's happening in these different sectors of the market. I can't just look at the S&P 500. I need to understand how things blend together. Volatility should not be a surprise. I should expect that, and I should be planning for it in my plan. And then last but not least, as we always say, please reach out with any questions. And with that, if you've got anything you'd like to dive deeper on, please let us know. Otherwise, we'll look forward to seeing you next quarter.